$40,000 less in mortgage approval. 4 innocent-looking Affirm payments. 1 denied loan application. That's not a hypothetical. That's the real-world cost structure of the BNPL trap that's about to reshape home buying power for millions of single workers earning $50K to $100K in 2024 and 2025. Here's what you think is true. Affirm and Klarna are interest-free payment plans. You only pay what you authorize. No hidden fees. No debt consequences beyond the purchase itself. Here's what banks think is true. Every BNPL payment plan you carry is now an installment account on your credit report. Your Equifax file shows it. Your Experian file shows it. TransUnion tracks it. And when a mortgage lender runs your debt-to-income ratio, they count every single monthly payment, not just the total purchase price. The delta between these two realities is approximately $40,000 to $100,000 in missing mortgage approval power. And I'm going to show you the exact math, the credit bureau reporting rules that changed between 2022 and 2024, and why this matters right now if you're planning a home purchase in the next 18 months. Let's start with the pattern interrupt. A household earning $75,000 per year, carrying BNPL payment plans on just 4 concurrent purchases at $150 per month each, that's $600 in monthly obligations. To a mortgage lender, that $600/month isn't optional lifestyle spending. It's debt. It counts against the 36% debt-to-income cap that determines your approval amount and your interest rate. Federal Reserve mortgage origination standards are clear. Debt-to-income ratio cannot exceed 43% for most conventional loans, and 36% is the sweet spot for the best rates. $75,000 annual income translates to approximately $6,250 in gross monthly income. At a 36% debt-to-income cap, you can carry $2,250 in total monthly debt obligations. That includes car payments, student loans, credit cards, and now BNPL plans. Here's where it gets invisible. If you're already carrying a $1,200 car payment and a $300 student loan payment, you've used $1,500 of your $2,250 allowance. That leaves $750 for new mortgage payment capacity. But if you add $600 in BNPL obligations across Affirm, Klarna, and similar platforms, you're now at $2,100 total monthly debt. Well within the cap mathematically, but your available mortgage payment capacity just dropped from $750 to $150 per month. On a $300,000 home purchase, that's the difference between a $1,500 monthly payment and a $150 monthly payment. That $1,500 payment finances approximately $300,000 in principal. That $150 payment finances approximately $30,000. The BNPL payments just cost you $270,000 in home buying power. But wait, it gets worse. Because Affirm, Klarna, and other platforms are now actively reporting to credit bureaus, and the credit bureaus are now categorizing these accounts in a way that impacts your credit score calculation. Vantage Score 4, 0, and FICO 10. The newer scoring models mortgage lenders now use weight installment account payment history and utilization more heavily than older scoring models. According to Klarna's H1 2024 investor report, the average BNPL customer carries 2 concurrent payment plans. Affirm's 10K filing FI 2023 shows that repeat customers, people making multiple purchases on Affirm accounts, average 8 purchases per year with average purchase values of $468. That's $246 in annual BNPL purchases for a single repeat customer, spread across multiple payment plans. Let's translate that into real monthly obligations. If that $246 is spread across 4 payment plans at, say, 4-month terms, you're looking at roughly $140, $170 per payment plan per month. 4 concurrent plans means $560, $680 in monthly BNPL obligations. For $75,000 earner, that's 5% to 4% of gross monthly income going to BNPL debt alone. Now here's the part that most people miss, and this is the open loop payoff I promised at the start. The credit bureau reporting cadence changed in 2023. Before 2023, BNPL platforms reported sporadically or not at all. But Affirm's 2023 10K filing explicitly states that they began increasing credit bureau reporting partnerships with all 3 bureaus, Equifax, Experian, and TransUnion, starting in Q2 2023. Klarna followed suit in their H1 2024 investor report, noting expanded credit reporting. That means if you opened an Affirm or Klarna account in early 2024, just 6 months ago, it's very likely now appearing on your credit report. And if you're planning to apply for mortgage in mid to late 2024 or early 2025, that reporting is fresh, visible, and factored into your debt-to-income calculation. The Federal Reserve's 2023 survey of consumer finances shows that BNPL adoption among workers aged 25-34 earning $50K, $100K jumped from 8% in 2021 to 31% in 2023. That's a 287% increase in adoption in just 2 years. and the median age of first-time homebuyers is now 33, which means the modal first-time homebuyer is exactly the person who's been using BNPL for the past 18-24 months and doesn't yet realize it's about to tank their mortgage pre-approval. Let's do the math on the lifetime cost. A single worker, age 28, earning $65,000 annually, uses BNPL for various purchases. $500 on Affirm for electronics, 4 payments of $125/month. $300 on Klarna for clothing, 3 payments of $100/month. $450 on another platform for furniture, 6 payments of $75/month. That's $300 per month in staggered BNPL payments, rolling continuously for 18 months, which is the modal BNPL payment duration across the 3 largest platforms. Over 18 months, they spend $400 in BNPL purchases. No interest technically, but the debt-to-income impact is real. When they apply for mortgage at age 29, their lender sees $300/month in installment accounts. They're still carrying that car payment $350/month and a small student loan $200/month. Total monthly obligations $850. On $65,000 income, that's 7% debt to income before the mortgage itself. At 43% cap, the standard for conventional mortgages, they have $2,800 per month available for total debt. After the $850, they have $950 for new mortgage payment. That finances approximately $400,000 in principal on a 7% mortgage, assuming rates remain stable. Now imagine they had 0 BNPL obligations. Their debt to income before the mortgage would be 5% $550/$65,000. At the 43% cap, they'd have $2,450 for new mortgage payment, about $500 more per month. That $500 difference finances an additional $100,000 plus in home principal. That's the $40K, $100K hit I mentioned at the start. Not in fees, not in interest charges, in lost mortgage approval power. But here's the second-order effect that most financial advisors aren't yet talking about. If your BNPL accounts show any delinquency or late payment, they're now weighted identically to credit card delinquencies in FICO 10T calculations. Affirm's 2023 10K shows that their delinquency rate for 4-month installment plans reached 12.1% in Q4 2023, meaning 1 in 8 customers missed at least one payment. A single 30-day late payment on a BNPL account can drop your FICO score by 150 points. At those credit levels, your mortgage rate can jump by 0.75 to 5 percentage points. On a $300,000 mortgage, a 1% rate increase costs approximately $3,000 per year or $90,000 over a 30-year loan. A single missed BNPL payment, something that feels minor and recoverable, can cost you $90,000 in lifetime mortgage interest. So let's close the loop on the belief gap. You thought BNPL was interest-free and consequence-free. The reality, BNPL is now reported, weighted, and factored into your mortgage approval and rate in real time. 4 concurrent $150/month payment plans reduce your home buying power by $40K, $100K, lower your approved mortgage rate by 0.5 percentage points. And a single missed payment can cost $90K in lifetime interest. The stakes are acute right now because we're in the first year of full-scale credit bureau reporting for BNPL. Mortgage lenders are still recalibrating their debt-to-income models. Some lenders are more aggressive in counting BNPL obligations, others are still catching up. If you're a single worker planning a home purchase between now and mid-2025, your BNPL history is your mortgage pricing lever, and it's probably working against you without your knowledge. The action to take is straightforward. If you have a mortgage application planned within the next 18 months, pull your credit reports from all 3 bureaus right now: Equifax, Experian, TransUnion. You can do this free once per year at annualkreditreport.com. Check for BNPL accounts. If you have them, check the reported payment status. If you're carrying multiple concurrent plans, calculate your total monthly BNPL obligations and add them to your existing debt-to-income ratio. You can find mortgage pre-approval calculators online that will show you exactly how much that BNPL debt is costing you in approved principal. If you're in the planning window and carrying high BNPL balances, the math favors paying them down before you apply for mortgage, even if it means delaying the purchase by 6 months. Paying off that $600/month in BNPL obligations unlocks $40K, $100K in additional mortgage power and potentially 0.5 percentage points in rate savings. The financial delta is massive. If you want the full numbers and the implementation checklist for recalculating your debt-to-income profile with BNPL obligations factored in, the deep version is in the companion book, The Latte Math, link in the description. It covers the math on every major debt category, including BNPL, and how each one reshapes your mortgage and refinancing windows. Here's the core takeaway. BNPL feels painless month to month because the payment is low and it's not labeled debt. But banks see it exactly as debt now, And that invisible debt is costing you tens of thousands in home buying power before you even know it exists. If this changed how you see BNPL, hit subscribe. I'm covering the credit card